So this week, I wanted to just take a look at what's happening in the market from a volatility, dispersion, and correlation vantage point. And it's very easy to sit here and just look at the S&P 500 and say, the trend is your friend and markets just go up forever. But that's not really what I do, and that's not how I like to analyze the marketplace. And so because of that, I like to try to take a much more detailed approach, and I think that that's what makes this analysis different. And these are the things that we discuss in the membership area as well. And so I think the first thing that's really noticeable when we look at volatility is the VIX index has clearly appears to have potentially changed a course of direction, a change in trend. And when I look at the VIX, the first thing that really stands out to me is that if you notice, the VIX has very slowly started to round higher. And if you also notice on the RSI, you can certainly see there's been a little bit of a trend change. Now, the VIX really isn't the easiest thing in the world to do technical analysis on, and it's not something you really should be doing because it is an oscillator. But in this case, it looks like there is a change in trend here taking place. And this is, I think, important because there's a couple of things going on in volatility that are suggesting that volatility really should be rising. And the next thing that I want to look at here is really what's called the constituent volatility index, and that's the VIXEQ. And you can see that this has actually been steadily trending higher. And so if you look right here, you can see this has been steadily trending higher. And when you add the VIX back in, you can actually see the divergence that's been taking place between the two, where the VIX has been rising a little bit, but you can clearly see that the constituent level, which is basically the S&P 500 components, the individual stocks, the average volatility within the marketplace, has actually been rising. And we don't have a whole lot of data here, which is kind of a shame, but this is obviously a newer index that's available for us to use. But we can clearly also see that this is at the upper end of at least what's been the historical range more recently. You'd have to go back to March of 2025. And then, of course, this was April, and this was January, and this was December. So, again, we don't really have lots of data to go off of, but you can clearly see that volatility on the individual stock level is equivalent to where we were really in the beginning of the year, which, remember, there was some choppiness at that point in March when we were in a drawdown. And obviously, this was much higher in April. But I think that these two things are really important to take notice of because there's a clear divergence taking place between the two. And this can tell us a lot of different things. And what this is also telling us is that there's a lot of dispersion in the S&P 500. And what's interesting is that we have lots of data for the dispersion index. But before we go too far, I just want to remind everyone, please remember to subscribe to this channel and like this video. Remember, I'm trying to grow in 2025 and in 2026 eventually, and I'll need your help to do that. When we look at the DSPX, which is the S&P 500 Dispersion Index, it goes back all the way to about 2015. Generally speaking, the trend in dispersion has actually been higher since 2020, and I don't know if that's because there's been some sort of shift in the marketplace with zero DTE and the advent of, more option availability. Of course, we know the advent of zero DTE came in 2022. But for whatever the case, there has clearly been a big shift and a trend change in dispersion. It's just been generally trending higher, where in previous years, what was considered to be elevated is really no longer as elevated anymore. But what's also very clear is that if we look at where dispersion is right now, it's very elevated at 34.3. The last time it was this high again was during the tariff tantrum in January, when we were seeing a little bit of changing in the marketplace. July of 24, if we remember July of 24, that was, of course, the period of time right before we went into that Yen trade where the yen was kind of falling apart. We saw a big drawdown in the S&P 500. We saw the Nikkei obviously collapse in that big 12% day. This was another period of time where we saw dispersion elevated, although not nearly as high in this period of time in March of 24. Dispersion also peaked here in July of 23. But really, when you look at where dispersion is right now, it's really more equivalent to where this period of time was. And you can see that it was much more equivalent to where we were in 2022 when the market was obviously in a period of greater volatility and heading lower. And then, of course, the next period of time where dispersion was really this high right here in September of 2020 when we had this going on. And then, of course, we also had dispersion very high right during the COVID crash. So again, dispersion is pretty elevated at this point in time, and that's important because eventually, this is really kind of verifying what we're seeing on the difference between the volatility of the index and the volatility of the constituents. And because dispersion is very high in the market, correlations are extremely low, which basically means that the individual components in the S&P 500 are not moving. They're less correlated to the actual volatility of the S&P 500, and that's clearly visible when you look at the VIX EQ versus the VIX. And so again, when we look at where implied correlations are, they're very low. And again, when we kind of think about where this is, implied correlations have only been lower really during this period in time here, heading into January of 25, which was when things were choppy. During this July of 24 period, which again was that period right in there. And then, of course, in here in July of 23. And then you really got to go back again to find lower correlations. Really, you can look at this period here, although it was a little bit higher again, the fall of 2018, and then right in here, which was right before Volmageddon. So again, we're sort of in this period of time where correlations are so low. It's usually preceded by heightened volatility in the S&P 500 and inside the stock market. Again, correlations go back a really long way, and you can see correlations. Here's the dotted line down here, all the way back to 2007. Correlations have been extremely low on a historical basis where we are right now, which also kind of suggests that we should really be entering some period of heightened volatility in the future. When we talk about volatility, the really interesting thing is that realized volatility is actually very low as well. 3-month realized vol, which I think is a really good measure here to use because the shorter dated levels of volatility are also very low. But I think in this case, 3-month realized vol is extremely low, and we have to go back and see that. You can see that realized vol right now is actually lower than where it was heading into that July of 24 Yemageddon episode. It's actually much lower today than it was heading before we headed into 2022. The only time that it's really been lower was heading into COVID, was heading into the December 2018 Christmas Eve massacre, and the basically the January 2018 Volmageddon episode. And if you really go back and look again, following the red line, this was another period of time right here heading into August of 2014. If you remember, we did see a heightened period of volatility, and it actually ushered in what was a period of nothing happening in the stock market, basically from September of 2014 until November of 2016. If anyone remembers, that was a very grueling period of time with lots of volatility in the market. But more importantly is that if you look at this more recent period of the time, and sort of in this period where options have become more prevalent, and we have a lot more volatility suppression type of regimes and trades in place, that this is sort of, I think, more analogous to what we've been seeing more recently. And also, if you notice, during these periods of time here, when the volatility was really low, we were having these melt up like scenarios in the equity market, very similar to what we're also seeing right now. And so again, when we kind of put all of these different pieces together, we have very low correlations, which have tended to precede big pullbacks in the market. We have very high dispersion, which has tended to precede very big pullbacks in the market. We have very low realized volatility, which has come before we've had very big pullbacks in the marketplace. And then I wanted to just take a look at a couple of other things that are sort of on my radar that I think is worth keeping an eye on. The other thing that I think is really important here is if you take a look at what's happening in some of these liquidity gauges, I like to call them. Wingstop is one such liquidity gauge that I like to look at. And you can see that Wingstop has been a fairly good predictor of where the equity market is going to be heading at some point in the future. Another stock which has come to my attention has been Blackstone. You can see Blackstone, which is private equity, has been getting hit really hard more recently. And Blackstone was a stock that, peaked here in November of 21. It certainly peaked here in early November of 24, and then peaked again in early January of 25. You can see it peaked here in December of 23 before we went into a little bit of a volatility area. And it even peaked, if you go back looking further in time, it even peaked before 2018, with it peaking in September. Another stock, Apollo Global, which is also a PE type firm here, you can see peaked early in October of 21, peaked actually well before COVID, January of 20, also peaked really back here in July and September of 2018. And you can see obviously peaked more recently, December of 24, made that lower high, and we've really been making lower highs since and kind of breaking down. And then there's another one, Ares, which is also a PE type firm. You can see getting hit pretty hard more recently. And I think it's worth even looking at some of the other names, right, in the Mag 7, even Meta, for example. I'll bring up Meta, and of course it will probably end up ripping the other way on Monday, but I bring it up anyway because you can see there's a history here as well. Peaked here in July of 2018, peaked in January of 2020, peaked here in August of 21, also peaked right around the high here in February of 25, just a little, maybe a couple days before. And it's clearly peaked already here in September of 25, and you could really even say August. If you've noticed, actually, Meta has given back all of the gains it saw following that earnings release, which I thought it was a strange rally anyway, but it's given back all of those gains as well. So I think there's lots of different ways that we can look at the market and assess it, and we know that there's been this rotation in the market where it seems like, every other day we have a different part of the market sort of lifting, where we have one day Mag 7 type names lifting the S&P, another day you have the other 493 lifting the S&P, and basically that's using the RSP. So if you notice, more recently the RSP has been kind of struggling, has been seeing more volatility, and that's also part of dispersion, right? So on days where the S&P 500 is weak, SPX is weak, you're seeing RSP have strength. Days where the RSP is weak, strong, S&P 500 is weak. That's also part of this dispersion, which we're seeing in the marketplace as well. So I think there's lots of different ways that we can assess the marketplace. And if we want to look at one last thing, I'll just bring your attention to the SMH, which has gone kind of vertical here. But I'll point out here that the RSI is up to 80, and when we are hitting the upper Bollinger Band, we were actually through it on Thursday and only came back in on Friday. So it's worth pointing out that typically, again, when you see these types of conditions, you're fairly overbought. Obviously here was a case after a big run up in June of 24, and then we made a lower high on the RSI in July of 24 while making a higher high on the close. So there's lots of different ways you can kind of keep track of this. I just threw a whole bunch of them at you. I happen to think the volatility, dispersion, and correlation metrics are very good. And those are telling us that we should really be prepared for greater volatility. These things tend to oscillate over time. And if you look at where dispersion is and where it's been, it's more likely than not that it's going to come back down at some point in the near term, just like it's more likely than not that you're going to see the VIX index probably move higher, more likely than not, off of some of the lower levels it's currently seen. Anyway, I hope you found this helpful. Please remember to subscribe to this channel, like this video, share with your friends, and we'll see you again midweek.